When buying a house, or paying one off, it's important to figure out what type of home loaner you actually are. If you have no idea whatsoever, don't worry, this video will help you swat away the confusion and figure out the best type of loan for you. First, let's tick off the basics. You find a house. You pay a deposit. You borrow the rest, and that amount is called the principal of your loan. Then you set a term for paying back what you've borrowed, and choose a loan type. This is where it gets tricky and your choice is crucial. There are a few different loan types to choose from, but we'll just focus on 4 really common ones. And quite often people will choose several different types, allocating a portion of their loan to one approach and a portion of it to another, and so on. So the big question is, which home loan approaches suit you? Are you a bit of a fixer? A fixer likes to know exactly how much interest they'll be paying on their loan for the foreseeable future. That's just how they roll, and by roll we mean budget their finances. So fixers choose a fixed interest rate loan for a set period of months or years. They don't mind that they can't adjust their payment amounts or make a lump sum at any time. They love certainty and wish the World Cup and lotto numbers could be more like their home loan. If you're not sure about being a fixer, you might be a bit of a floater. Floaters are a flexible bunch. They like variable floating loans with interest rates that rise and fall when people in suits with calculators fiddle with the market each day. Floaters enjoy being able to adjust their payments any time, to take advantage of low interest rates or to minimise the effect of high ones. Floaters can also lump sum that sucker, paying off chunks of their loan anytime they like. Whoa, look out! Here comes the offsetter. Word 'em up. Here we go, this might be more you. Offsetters like to make an impact, and it's no different with their home loan. Offsetters want all the good work they're doing in their other bank accounts to have an impact on what they have to pay for their loan. So they get what's called an offset variable loan that only some banks offer. It looks at their loan amount and deducts the positive balances of their savings and everyday accounts before calculating the interest to pay on it. Classic offsetter, leveraging assets with street-smart know-how. It's time for the final option. It's time to consider if you might be a revolver. Sounds dangerous, huh? On the contrary, these folks are budgeting enthusiasts. They prefer a revolving credit home loan because it puts all their accounts into one giant overdraft. Each day, as they receive income, pay bills, or sell a birthday present, the balance of their revolving credit account adjusts, and the interest is only charged on that balance. If they manage it carefully, they'll pay less interest in the long run. Kaboom ski! So, those are the 4 main approaches to setting up a home loan. And remember, it's also really popular to structure up portions of your loan with different approaches. If you think you might be a mixture like an offset floater, or a fixed revolver, or some other combination, just talk to your bank about the possibilities. The important thing is, you have the knowledge. You know what's best for you, and you're in control when arranging your home loan. Now get out there and own that home.